Hey guys, it's Liquid here. Welcome back to the channel where I share wealth building strategies from around the world. In today's video, I'll tell you what the best investment you can make is. You're not going to find it in the stock market, and it's also not something you can touch. That's because the best investment you can possibly make is to improve your own financial knowledge and competency. That's it. That's the answer. And I know it sounds like a cliche, but there is actually a lot of deep meaning to unpack here. You've probably heard some variation of invest in yourself or invest in your education dozens of times already. And it sounds so overused. I know when I first came across this advice in my 20s, I thought, okay, the more you know, the more you can earn. It makes sense conceptually, but it sounds way too general and not very actionable or practical. Like, how exactly do I gain financial knowledge? And once I have it, how do I make money from it? It just seems too abstract to be useful. I think that's why many people, including myself at the time, underestimate the significance of financial knowledge. But now I have a much deeper understanding of it, so I want to share what I've learned about financial knowledge over the last 10 years. And by the end of this video, you won't just understand why it's the best investment you can make, but you'll also realize how this knowledge naturally produces abundance for anyone who is in possession of it. Over the years, I have experienced firsthand how financial knowledge has transformed my personal life. An investment in financial knowledge and competency is kind of hard to define because it's a system of mental models and confidence built through lived experience. So, the best way to demonstrate the sheer power of financial knowledge is by using a concrete example. Let's say we have Bob. He's worked hard all his life and he's getting ready to retire in his 50s and plans to buy a rental property as part of his early retirement plan. Bob is going this route because he has experience being a landlord in the past, and he knows where to find the best investment properties in safe neighborhoods with low vacancy rates. He also understands how to properly insure his investment. He knows how to screen for high quality tenants, and over time, he has acquainted himself with people who can help him fix and maintain his property. So, after a while, Bob is able to find a suitable property that he likes. It's in an up and coming neighborhood that should see lots of development and people moving in over time. He pays for the house entirely with cash and manages to rent it out, receiving a 4% return on his investment. A few years later, his tenant decides to move out, but that's actually good for Bob. The rent in the area now allows him to make a 5% return from net operating income. But not so fast, because Bob likes to learn about investing and he has a decent understanding of his local rental market. Bob knows that a renovated suite can rent for more money, so he puts in some new floors, gives the wall a fresh coat of paint, and adds a new bathroom. He then rents out his property and receives a 6% net return on the adjusted cost of his investment. In the traditional sense, this retirement plan might seem kind of risky. It violates the 4% safe withdrawal rate because Bob is technically living on 6% of his investment. But Bob doesn't understand the stock market very well, so investing in real estate is probably the safest and most appropriate choice for him. Now, Bob has a coworker of the same age, and his name is Kyle. He saved up the same amount of money as Bob over the years and is now going to retire in his 50s as well. Both Bob and Kyle will start to receive a work pension when they're 65 years old. So Kyle doesn't know as much about real estate investing as Bob. So Kyle keeps all of his money in the financial markets. Based on his risk tolerance, his financial advisor suggests Kyle retires with 50% of his portfolio in stocks and the other 50% in bonds. Kyle hasn't done much research on investment strategies, so he listens to this professional advice. Since interest rates are currently really low, the bonds portion of Kyle's portfolio is really dragging down his returns. He's also very conservative with his investments and follows a strict 3% safe withdrawal rate. So, to recap, they both started with the same amount of money to start their early retirements. Here's what's interesting though, it's not obvious that Bob, who is withdrawing 6%, is at greater risk of depleting his net worth than Kyle, who's only withdrawing 3% from his investments. And that's because you can't measure risk based on withdrawal rates alone. You have to look at what specific assets make up a portfolio, as well as the competency of the investor who's managing that money. Bob has a lot of specific knowledge around real estate. He knows how to turn it into a short term rental business in the future if he wants to increase his returns. He could also add a wall down the middle and split his property into two separate rental suites. I guess it's a good thing he put in that extra bathroom. He could also one day decide to move into one of the suites and use his extra savings to invest in index funds or something else. There's just so many different ways for Bob to extract additional value from his investment because he knows how to do it. Plus, Bob faces no interest rate risk because he doesn't have a mortgage on his property, and he doesn't experience the volatility of the stock market. In this particular situation, a rental property is probably the safest investment for someone like Bob. On the other hand, Kyle has no control over how his stocks and bonds will perform. He hasn't looked into how to optimize his portfolio because he just follows the advice of his financial advisor. There's a lot of unknown risks associated with not understanding what you're invested in. That's not to say either Bob or Kyle's investment strategy is better or worse than the other, but here's the takeaway. Bob withdraws 6% a year and Kyle withdraws 3%, which is half as much. This means Kyle will require a starting portfolio that's twice as large as Bob's, assuming they have the same spending habits. For example, if they each need $60,000 a year for living expenses, Bob's nest egg would be worth $1 million, but Kyle's nest egg will need to be worth $2 million or twice as much. The difference in how much they need to save in order to retire is $1 million. So what does this money represent? Well, this $1 million is the value that Bob has created for himself because he has that financial knowledge, specifically the knowledge he learned from being a landlord. It's certainly harder to save $2 million than it is to save $1 million, but the more financial knowledge you can leverage, the less money you actually need to save in order to reach your financial goals. In other words, the more competent you are at managing money, the more value you can extract from your existing portfolio. This is the power of financial knowledge and competency. In this case, his experience as a real estate investor has given Bob the ability to withdraw a higher amount than Kyle. This gives Bob the freedom to either retire earlier or to spend more money in retirement or both, and this privilege has a value of $1 million. You can also obtain financial knowledge in the stock market. Many dividend growth investors have spent years researching companies that have a long history of growing their dividends. Lots of profitable companies in a wide range of sectors pay dividends over 4.5%. It's perfectly reasonable to see a dividend growth investor create a portfolio made from 100% blue chip stocks, and maybe this portfolio has an average yield of 5%. All the holdings will have a long track record of increasing dividend payments year after year. The investor can then implement a variable withdrawal strategy where they can spend between 5% to 6% of their nest egg every year depending on market performance. This seems like one of the easiest ways to make passive income in retirement. The Golden Butterfly portfolio is another strategy where investors can safely withdraw over 5% a year without worrying about running out of money in retirement. The difference between someone who can safely withdraw 6% from their portfolio and someone else who can withdraw, say, 4% safely is financial knowledge. If you have the knowledge of trading options, then you can also use a very conservative strategy to earn an extra 3% a year from your portfolio with minimal risk. I plan to do this as part of my retirement strategy. As you can see, there are so many different ways to benefit from financial knowledge. It can give you higher investment returns, help you retire early, give you more confidence, and provide opportunities and options that are specific to your situation. So hopefully now all the pieces are falling into place and you have a solid understanding of why it is the best investment you can make. An investment in financial knowledge and competency can create an absolutely insane ROI over time. It's part art and part science, but the goal is for you to optimally place yourself within the interconnected web of the financial system so that you have the most potential to create abundance. And it gets better because financial knowledge compounds. This means you can stack your financial skills to produce even greater results. For example, apply an option strategy that earns 3% yield in premiums to a stock portfolio that's already generating a 4% dividend yield, and you can effectively create a 7% total return. And this is purely income, so any stock appreciation over time is just icing on the cake. You can also borrow cheap money responsibly to add more funds to this portfolio to further enhance the investment returns. You can see how powerful this can be, and the best part is there are no limits to how much financial knowledge and competence you can possess. The more knowledgeable you are about money, the more financial opportunities will be attracted to you. Without financial knowledge, you don't know which real estate property will make a good investment. You don't know which options are relatively safe to trade. You don't know which companies are likely to cut their dividends. And you don't know how to limit your downside risk when you invest with leverage. So you can probably afford to miss out on pretty much any other investment, but you cannot afford to miss out on learning how to manage your finances. The good thing is any financial knowledge can be learned. As Benjamin Franklin once said, an investment in knowledge pays the best interest. And I would just like to add that it's financial knowledge specifically that pays the absolute best interest. So thanks a lot for watching. I've been getting a lot of new viewers lately, so when I reach 500 subscribers, I plan to reveal everything I have in my investment portfolio. So keep an eye out for that in the near future. So happy investing, and until next time.